Scouring the news is a daily part of the job for a country risk analyst, but only actually provides one piece of the puzzle. Context is key in determining if current global events impact a country's risk position. To see the whole picture, our latest Country Risk Quarterly, an insightful interactive tool, is informed by a review of EDC Economics' rating actions in 2021. While 2020 saw the downgrade of more than 70 countries, the ratio of downgrades to upgrades was almost even in 2021. This suggests cautious optimism that country risk has stabilized, albeit at higher than pre-COVID-19 levels. EDC's short-term risk rating, which measures the likelihood of commercial default for domestic counterparties over a one-year time horizon, is the best measure to gauge the trajectory of an economy's near-term recovery. This rating looks at indicators like inflation, economic growth, exchange rate volatility, and the government's fiscal position. In 2021, almost 15% of all markets rated by EDC had their short-term rating upgraded. This was heavily skewed towards developed markets in Europe and Asia, who have been leading the global recovery due to higher vaccination rates and stronger fiscal support measures. We believe that this trend is likely to continue as EDC Economics' latest economic outlook, global economic outlook, forecasts above trend growth for developed economies over the next 2 years. Among emerging markets, the picture is a bit more mixed. The recovery of tourism-dependent economies has been further delayed by the impacts of the Omicron variant, while those that rely on commodity exports will benefit from higher prices across the board. Elevated commodity prices, a product of pent-up demand and current supply chain constraints, continue to drive inflation. This, we believe, will prompt central banks to rein in accommodative monetary policies with implications on our sovereign probability of default ratings. Led by the US Fed, we expect leading central banks to swing into a tightening cycle, causing borrowing costs for many governments to rise. This is a key issue, as sovereign debt has soared over the last 2 years. In fact, the IMF estimates that about 60% of low-income countries are at high risk of debt distress. That's double the number in 2015. Countries such as Argentina, Tunisia, Ghana, Sri Lanka, and Egypt, which have high public and external debt, are particularly vulnerable to shifts in US monetary policy. While public financing needs have fallen from the highs of 2020, they are expected to remain well above pre-pandemic levels for many emerging markets. The G20's debt service suspension initiative was successful in providing temporary debt service relief, helping to manage the liquidity of the poorest countries.